Order! Order! You are an incorrigible delinquent at times. Behave yourself, man! But after...
Primary objective is price stability, defined by the government as a 2% CPI inflation target. CPI inflation was 3% in September, and it's expected to have risen a little further in October. But it isn't so much.
The Bank of England hinted last month that interest rates would rise. They have done for the first time in 10 years. Mark Carney.
The MPC must set policy to achieve a sustainable return of inflation to target. That is, we must aim to bring inflation back to target and to keep it there once the effects of temporary factors, currently predominantly those caused by the referendum-related fall in sterling, dissipate. So in many respects, today's decision is straightforward. With inflation high, slack disappearing, and the economy growing at rates above its speed limit, inflation is unlikely to return to the 2% target without some increase in interest rates. Of course, these aren't normal times. Brexit will redefine the UK's relationship with our largest trade and investment partner, and it will have consequences for the movement of goods, services, people, and capital, as well as the real incomes of UK households. The MPC has repeatedly emphasized that monetary policy cannot prevent either the necessary real adjustment to new trading arrangements or the weaker real income growth likely to accompany that adjustment. We can, however, support the economy during the adjustment process. In such exceptional circumstances, the MPC is required to balance any trade-off between the speed at which we return inflation sustainably to target with the support that monetary policy provides to jobs and activity. At the time of the referendum, the MPC set out our framework for doing so, and we followed it consistently ever since. The MPC's assessment of the outlook for inflation and activity published today is broadly similar to our projections 3 months ago. In our forecast, conditioned on the gently rising path of bank rate implied by current market yields, GDP grows modestly over the next few years at a rate just above its reduced rate of potential. Consumption growth remains sluggish in the near term before rising in line with household incomes. Net trade is bolstered by the strong global expansion and the past depreciation of sterling. Business investment is affected by uncertainties around Brexit, but continues to grow at a solid pace, supported by strong global demand, high rates of profitability, the low cost of capital, and the limited spare capacity. The MPC judges that there's a little less slack at the start of the forecast period than in August. More fundamentally, the pace at which the economy can grow without generating inflationary pressures has fallen relative to pre-crisis norms. This reflects persistent, and I underscore persistent, weakness in productivity growth since the crisis, and more recently, the more limited availability of labor. Over the next few years, modest demand growth is expected to use up the little spare capacity remaining in the economy, and domestic inflationary pressures are likely to build. With unemployment at a 42-year low, inflation running above target, and growth just above its new lower speed limit, the time has come to ease our foot a little off the accelerator. That will help bring inflation back towards its 2% target while still supporting jobs and growth. So what will be the impact of this change? Changes in interest rates work through several channels. Rate increases obviously reduce the current cash flows of borrowers and increase those of savers. Interest rate increases also make it more attractive to save today to consume tomorrow, and less attractive to borrow to spend today. And interest rates are one of many influences on exchange rates and other asset prices. While the sheer novelty of the first increase in bank rate in a decade creates some uncertainty around its impact, there are reasons to expect it to be no larger than usual. Households are generally well positioned for a rate increase. More people are in work than ever before. Only about a fifth of people with mortgages have never experienced a rate increase. Of those, almost half of those took out their mortgages after the FPC introduced its affordability stress in 2014. And I'll remind that that affordability stress requires mortgagors to be able to withstand an increase in their mortgage rates to around 7 percentage points. Fully 60% of mortgages are at fixed rates. And even with this bank rate increase, many households will refinance onto lower interest rates than they're currently paying. And I'll give you two illustrations of that, by around 30 basis points for those moving off expiring 2-year mortgages, and by almost 2 percentage points for those moving off 5-year deals. Company balance sheets are generally in strong shape, with the share of profits required to meet monthly debt repayments falling to its lowest level in almost 2 decades, in more than 2 decades. Financial conditions remain highly supportive, and demand is growing strongly in the rest of the world, robustly so in our largest trading partner. So what will happen, pardon me, what will happen next? As always, the committee will monitor closely the incoming evidence on the economic outlook, including the impact of today's increase in bank rate. To be clear, even after today's increase, monetary policy will provide significant support to jobs and activity. And the MPC continues to expect that any future increases in bank rate would be at a gradual pace and to a limited extent. Current market yields, which are used to condition our forecasts, incorporate 2 further 25 basis point increases over the next 3 years. That gently rising path is consistent with inflation falling back over the next year and approaching the target by the end of the forecast period. The MPC will, of course, react to developments to the extent they affect the outlook for inflation and activity. And in this regard, Brexit remains the biggest determinant of that outlook. The decision to leave the European Union is already having a noticeable impact. The overshoot of inflation throughout the forecast predominantly reflects the effects on import prices of the referendum-related fall in sterling. Uncertainties associated with Brexit are weighing on domestic activity, which has slowed even as global growth has risen significantly. And Brexit-related constraints on investment and labor supply appear to be reinforcing the marked slowdown that has been evident in recent years in the rate at which the economy can grow without generating inflationary pressures. The impact of Brexit on the forecasts will evolve as negotiations progress. In particular, a reassessment of the economic outlook would be prompted by any resolution of the uncertainty about the nature of or transition to the UK's future relationship with the European Union, insofar as those changes affect the behavior of households, businesses, and financial market participants. Well, the direction of that reassessment for activity and inflation is not automatic. The MPC's response will be consistent with its remit and the framework we followed since the referendum. By continuing to balance the trade-off between the speed at which inflation is returned to target and the support that monetary policy provides to jobs and activity, monetary policy will continue to make its best contribution to the prosperity of the people of the United Kingdom. And with that, Dave, Ben, and I would be pleased to take your questions.
Okay, could I just, as always, remind you, please give us your name and the organisation you represent, and you will need to keep to one question only for the first time we go around, please. Kamal first.
Kamal Ahmed from the BBC. Governor, for many millions of people today, their cost of living will go up. You've got real incomes falling. You've got the economy subdued. For people struggling to make ends meet, can you understand that they simply won't understand why you have decided to raise interest rates today? And Sir David, if I could just briefly ask you why you disagree with the Governor.
The first thing I'd say is that the rate of growth is slower than historic norms, but it's not subdued. I think we have to get used to an economy. After all, this is an economy that's operating with unemployment at a 42-year low, more people in work than ever before. this isn't a false read on the unemployment rate. People are in the labor market, they're working, and the degree of spare capacity in the economy is very limited. So the question about the speed limit of this economy going forward will be increasingly determined by the rate of productivity growth, which, as you know, has been very slow since the crisis and is expected to be so going forward, even though we have some pickup. But to take a step back, look, what we're doing is easing our foot off the accelerator. This is a modest adjustment in interest rates. It will have an impact on borrowers over time. It will have a more immediate positive impact on savers in terms of deposit rates. It leaves monetary policy in a position where it still is highly supportive of jobs and activity, and you can expect it to have. In fact, it is the policy that is providing a boost to the economy relative to headwinds from other policies, including fiscal policy and the uncertainty associated with Brexit. In terms of households' financial positions, they have been difficult, as you know, over the course of this year with the real income squeeze. The worst of that real income squeeze is ending, and this is part of ensuring that it doesn't come back. In other words, ensuring that inflation returns to that 2% target in a sustainable manner, in a way that supports the economy, in a way that supports keeping people in work and moving forward. In terms of Dave?
Thank you, Governor. All of us are here, as is always the case, to explain the decision that the MPC has taken today. Reflecting our commitment to transparency, you'll see in the minutes that there's a paragraph setting out the high-level view of the two members of the MPC who didn't vote for an increase in bank rate. I'll have plenty of opportunities in the coming period to explain in more detail my position, but today is about the MPC's decision.
Phil and then Ed. So, Phil on the side there.
Hi, Phil Aldrich at The Times. It's the first rate rise in a decade, but I think the last time there was a rate rise cycle was about 14 years ago. And I just wondered if, all other things being equal, we don't get any sort of surprise negotiation outcomes of Brexit. Could we see this as the start of a rate rise cycle?
Yeah. Well, the first thing to say is that as we've stressed in all our communications in the forecast, I stressed in my opening remarks, our forecast is conditioned on a market curve which has 2 additional rate increases over the forecast horizon, and we in fact need those 2 additional rate increases in order to get that return of inflation to target. And in fact, if you look closely at the forecast, inflation approaches the target. It doesn't quite get there. And the economy is likely to be in a position of excess demand, in other words, running a little hot at that point. So the judgment of the committee has been that that's the right way to balance the trade-off at this point. There's another way to illustrate the point, which, I mean, you'd be familiar with, Phil, that we release another forecast, which is just one that has a constant rate. Now, the constant rate is at the half a percentage point, the rate at which we've just moved bank rate. And if you look at that out to 2 years, inflation's just below 2.5%, and the economy, unemployment is less than 4%. The economy is running above its potential rate of growth. I would remind, and that strikes as a trade-off beyond the tolerance of the MPC, to be clear. I would remind of one other thing, which is that our normal horizon to return inflation to target is 18 to 24 months. Because we're in exceptional circumstances, because there are these headwinds to the economy because of the real income shock and uncertainty and other factors, we have stretched out that horizon over which to return inflation to target. But there are limits to the degree that we can do that. And certainly when the economy is in a position where more people are working than ever before, when there's a very limited spare capacity in companies, and when the speed limit or the rate of potential growth, rate of productivity, different elements of the same thing, saying the same thing, is quite muted. It does require some recalibration of monetary policy. Last point, at the start, you said an important caveat, which is subject to some major development on Brexit. And as I said in my opening remarks, and we said in the MPS, if there is resolution of some of the big questions around Brexit, transition deal on the end state, you would expect that to affect how the economy functions. You would expect that to change the economic outlook, and if you have those two components, you would expect some recalibration of monetary policy at that point. Monetary policy has the advantage of being the most nimble of the macroeconomic levers. I would caution, though, that the consequences of resolution on Brexit are not, this is something we've said since before the referendum, are not automatic for the path of inflation. Doesn't necessarily go in one direction.
Hugo at the front here, and then Ed.
Thank you, Hugo Duncan from the Mail. Governor, what impact do you expect this rate hike to have on savings rates? Should banks, building societies and others be passing this on in full to savers?
Yeah, Hugo, we would, and actually I'll ask Dave maybe to supplement a bit. We do expect it to be passed on. Banks did pass on the cuts to their depositors, and we expect competition to push it in the other direction. And obviously we watch it closely. I would say as well that in terms of the short-term dynamics, since there's a lot of fixed-rate debt, fixed-rate mortgage debt, as you know, which isn't going to change in the short term because of the bank rate increase. And actually most consumer credit is relatively insensitive to the level of bank rate because there's so much spread on top of it. I mean, if credit card fees are in the high teens percentage points, exactly where bank rate doesn't make a big difference to it. And of course, student loans are unaffected by this. But on the savings side, we would expect pass-through, and Dave, I'll ask you to supplement.
Already we're seeing, reflecting what's been happening in markets, that the average rate on fixed rate saving products has been going up this year. So on 1 and 2 year fixed rate bonds, we've seen increases of 0.2 and 0.4 on the rates between January and September this year. So we're already seeing some anticipation.
Okay, Ed, and then Jason behind.
Ed Conway from Sky News. One of the interesting points that you've talked about is the potential supply growth estimate being at 1.5%, potentially quite a bit below where it would have been previously. Can you explain how much of that is down to long-term secular trends, UK productivity trends, and how much of that is a Brexit effect?
Yeah. I'll start, pass to Ben to flesh out. The first point is the big news has this issue has accumulated since the crisis, as you recognize. The long period of lower investment, long period of poor process investment, if I can put it that way, poor total factor productivity growth, and what we had, and it didn't really matter for the speed limit of the economy. For a period of time because we had so much spare capacity in the labor market. And there's a chart in the inflation report, I think at the start of chapter 3, which shows that basically all of the growth had been supported by an increase in labor supply. Well, we're getting to that point, not surprisingly, with the unemployment rate at 4.3, with participation rate very high, with a shift in a lower rate of net migration. All those factors means there's just much less labor supply come in. So these longer-term factors are starting to bite. Yes, Brexit has, so that's the biggest part of the story, to be clear. The productivity puzzle is the biggest part of the story. It has been reinforced over the course of the last year by some of the Brexit effects, and they're twofold. One is just less investment, and I think we've pointed this out in the past, but basically if you look at our May 2016 forecast for investment relative to our August forecast and this one, which is broadly the same, it's about an 18 or so percentage point difference in the level of investment at the terminal point of the forecast, the common terminal point in 2019. And then the second thing is around total factor productivity or process investment, and we talk a bit about that in the report. One of the challenges, which is just starting to show up, and again, it very much depends on what type of final arrangement is negotiated, is a supply chain effect and some of the knock-on effects on total factor productivity. So we are seeing some of that. I would just reinforce that what we're saying is, I'm going to reinforce that this is reinforcing something that has been there, as opposed to it's something that's totally new that just started in last summer. But
yeah, no, I'll just flag again the graph that the Governor mentioned. It's on page 22, and it makes pretty clear, I think, how unusual this period is, how much of the growth, almost all of it, over the last decade, since the crisis at least, has come from increasing labour supply, a bit on average hours, mostly employment growth, not from productivity. There has been a period, a 10-year period in the UK when you haven't had any productivity growth, but you have to go back to sometime in the 1860s or 70s to see this. So it's a long-standing trend. It's not unique to the UK, although we've probably felt it more severely than others, right? So productivity growth has slowed in just about every advanced economy since the crisis. But we've had it's been more severe in this country than others. And I think the committee has identified on top of that things, as the Governor said, since the referendum that are probably reinforcing that trend and will continue to over the next couple of years. One other thing I'll point out, we have not changed that view since August, right? So this is not a new development since August. It's not something we've suddenly done and for that reason decided to raise interest rates. What is clear is that the consequence of this is that unemployment has continued to edge down, and that is just one sign of the fact that the slack in the economy has narrowed. That blue bar in that chart doesn't have much room to contribute on the sort of scale it has done over the last few years.
Okay. Jason and then Simon. Sorry, the microphone at the back there. Thanks.
Hi, Jason Douglas from the Wall Street Journal. This increase in bank rate is coming at a time when the Federal Reserve is also raising interest rates, when the European Bank is signaling that it is going to begin paring back its stimulus in January. And I suppose my question is, are we having a bit of a moment in central banks sort of post-crisis when people are beginning to move together to withdraw some of this stimulus? And do you feel part of that, or is this really just responding very much to the peculiar situation of the United Kingdom? Thank you.
Well, look, the global economy is firing on, I think we say most cylinders, although I think we need a 12-cylinder engine to say most cylinders. I mean, it's 11 out of 12. The global economy is doing very well. I'll just draw your attention to capital goods chart that is almost off the charts in the report. So it's not surprising that as growth is picking up in a number of jurisdictions that the stance of policy is changing, and it's not surprising for those economies that are particularly open that it's having some influence. So all of that is there. It creates some possibility, and that's some possibility of a movement in upwards over time in equilibrium rates as well. I've made the point particularly the extent to which this is an investment-led or a heavy investment component to the global recovery. The UK is participating a little less in this global upswing. We are participating in it. Net exports make an important contribution to growth. Investment is stronger and it's helped by that global growth. It's not as strong as it normally would be. And we are going through a period, in part caused by the fact that we picked up earlier than Europe, but I think in part caused by idiosyncratic issues here. It's a relatively unusual period of underperformance for the UK at a time when the global is, at least the G7 is doing as well as it is. So synchronized pickup globally, it makes sense. Everyone obviously bound by their own situations, and we have certain unique elements here that we're grappling with.
Okay, Simon at the front.
Simon Viger, 5 News. A lot of people watching this will be delighted and maybe a bit surprised that you think wage growth is going to pick up. Can you explain why you think it's going to?
Sure. We think a couple of things. I'd make 2 points on the real income squeeze. Obviously, there's 2 elements to that. One is that inflation coming down, and then your question about wage growth picking up. Let me just be clear on the former. The first element of, we do see inflation going a little higher in October, but then as we get into the turn of the year, some of the base effects, use that terminology, but I just lost your viewers. But we see it easing off in 2018, and the question is finishing the job and bringing it back to that 2% target over the right horizon. In terms of wage growth, it starts with a labor market that is tightening. The unemployment point I've made, we do see that a variety of indicators that show greater tightness in the labor market. Vacancies are at elevated levels relative to post-crisis. The level of churn, so-called churn in the job market, has picked up quite sharply. So people are taking risks, moving to new jobs, moving between firms. That's a healthy development. And in fact, if you adjust for self-employment, which has gone up, it's more or less back at pre-crisis averages, so that's a positive development. We see that wages for new hires are notably higher than existing wages, so there is that differentiation. But of course, as more people are moving between firms, it can fill out. There's quite strong survey evidence, and I would single out particularly our survey evidence, the survey of the bank agents. So a year ago, when we were sitting here, the view of our agents based on the company visits and the surveys that they do was that wage growth was not going to pick up in 2017, and they were right. And it's actually quite an effective survey. In fact, it is now, the new survey is that wage growth will pick up in 2018. So there are a variety of factors that suggest it. One of the requirements, though, for wage growth picking up, which we shouldn't underestimate, is that productivity picks up as well. One of the reasons why wages have been weak is productivity has been weak, and we do expect some pickup in productivity associated, not least with a pickup of investment and a sort of shift between labor and capital. And then the final point is the nature of the jobs that are being created. Part of what we've seen is so-called compositional effects. The nature of jobs have been lower wage, lower skilled jobs, or the people who have filled them haven't had the skills yet, and that's had a temporary, we think, a temporary effect on wages. So we do see a pickup, Simon. It'll gradually build through 2018 into 2019, and the only thing I don't want to mislead is that the rates of wage growth we see towards the end of the forecast are still below historic averages. So we're talking about 3.25 type percentage point increases in wages as opposed to north of 4%, which people would have been used to prior to the crisis. Do you want to?
No, I only wanted to say, obviously we've been disappointed by this before. We've said we'd expect it to pick up in the past, and it hasn't. The main reason for that has been disappointments on productivity. What is true, the MPC still believes, and I think the evidence still clearly suggests, that there is a kind of Phillips curve. You would expect, as the labour market tightens, for that to have some effect on wage growth, and we think we're seeing signs of that. One other point, if I may, which comes back to a question of Kamal's, you should be careful about looking at annual growth numbers, certainly, say, for wages. The latest data we have are what happened to wages between the summer of 2016 and the summer of this year, and then saying real incomes are still falling. Now, that's quite a backward-looking thing. The worst part of that squeeze was actually in the early part of this year. And right now, if you look at what's happening right now, are roughly flat, maybe even edging up slightly. So we think we're past the worst already. Prospects for next year depend critically, as the Governor said, on productivity again. But given that, we also think there's some effect of narrowing slack on the prospects for wage growth.
Okay, Ben, and then if you could pass the microphone one back when you're done.
Governor, I want to raise the issue of policy mistakes. 10 years ago, when the bank last raised rates, it had to cut them again within 5 months. In 2011, when the ECB raised rates, it had to cut them again in an equally short amount of time. If the Bank of England does end up reversing this rate hike over the coming year, how should we think about that? Should we think about that as a nimble response to an unforeseeable or low probability event? Or would we be justified in calling what you've done today as a mistake?
Let me reflect on that for a minute, Ben. I vote for nimble response. I'll check with my colleagues. Look, I think the way to judge it, so let's talk about the most likely reason for an adjustment in policy in either direction. And I really want to stress that if you take one thing away, in either direction, with if there is some form of resolution around the big issues around Brexit, either having a transition deal or much greater clarity about the end state. And the parties are working hard in the negotiations to solve both of those issues. So when that becomes known, the answers to those questions, almost certainly that is going to have an impact on the way businesses and households but think about the future, think about their investment plans, spending plans. It will have certainly an impact on a range of financial asset prices, notably the exchange rate. And we as a committee will have to step back and assess the new outlook and calibrate policy appropriately. If that's an acceleration in the pace of raising interest rates, because the balance of demand and supply and exchange rate effects warrant it, that is an appropriate response, nimble, appropriate response. If it requires some more support for the economy, again, because of the mixture of those exchange rate supply and demand effects in our judgment, that again is a nimble, appropriate response. That's adjusting to a change. And the way I'd suggest we would suggest to think about it is we have laid out as best we can our framework for to living in these uncertain times or these exceptional times and adjusting policy. Since August of 2016, we have very clearly laid out how we think about the trade-off. And now there are a series of decisions around that, which started with the initial decision to provide stimulus in the wake of the referendum, including guidance on potential for additional stimulus if the forecast went in a certain direction or if the outturns went in a certain direction. Then a series of decisions to hold policy, including at times when the trade-off went in an adverse way so that inflation had a bigger overshoot farther out relative to what we were gaining in terms of jobs. And then the decision today about, in effect, the limits of that tolerance for the majority of the committee, which again is information about how we would react. And different people are going to have different views about the probability of an agreement, the impact of an agreement on the economy, but they have increasing information about how the MPC will view the trade-offs that are involved and the calibration of policy accordingly.
I mentioned one other statistic worth remembering. We've come from this extraordinary period where we've been up against the lower bound, and so interest rates haven't changed. Go back before the crisis, interest rates used to change on average every 4 months, I think. And the average interval between the last move in one direction and the first in another was maybe 7. So you say in the next year, but in times before we were at these very low levels, these changes weren't uncommon, nor were, and one has to respond to events as they come along, whichever direction.
Jemana Bersachi from CNBC. I just wanted to ask whether you've had any discussion.
Rest of that news conference there with the Governor of England, Mark Carney, answering questions about the decision to raise the interest rate to 0.5% the first time in a decade. Quite a significant move. What impact will that have on you and your budget? Standing by for us, Ian King. Ian, what have you made of what the Governor of the Bank of England said so far?
Well, what we've heard from the Governor, Julian, is a very categoric statement from Mark Carney, setting out very, very clearly why the Bank of England has chosen to raise interest rates for the first time since July 2007. He spelled out very clearly the ability of both households and businesses to withstand what is, after all, a very, very modest interest rate rise. And then it was this line in the statement where he's talking about the level of slack in the economy, which is what the Bank of England looks at. The less slack there is, the more likely it is that any sort of uptick in growth or fall in unemployment is going to lead to higher inflation. And there's this line here: the steady erosion of slack has reduced the degree for which is it appropriate for the MPC to accommodate an extended period of inflation above the target. And he goes on to say there, and you heard him say in the press conference, unemployment obviously at a 42-year low. The MPC judges that the level of remaining slack is limited, and that's why, in a nutshell, they've decided to raise interest rates. Now, the market reaction has been very, very interesting, because sterling has fallen by some 1% against the US dollar, by 1.25 percentage points against the euro. And obviously, before the rate decision, I was mentioning the fact that sterling had risen this week on the foreign exchange markets. That was in anticipation of a rate rise. What the market now appears to be doing is assuming that there's going to be no more interest rate rises in the near future. This is the so-called one and done theory. But what's really interesting when you look into the inflation reports, now the bank publishes these fan charts which show you where they see potentially inflation going. And it is quite clear that if interest rates remain at 0.5% at the level to which they've been raised today, then you're still going to see inflation going out over the next couple of years at well above the 2% target rate and nearer the 3% that we have at present. And therefore, that really does imply that there are going to be further interest rate rises coming down the line, possibly one in the second quarter of 2018 and then one beyond that. I mean, by 2020, you're probably looking at interest rates of around 1%. And it's surprising, really, that the market doesn't appear to be pricing that in. Another hint of that, incidentally, is in the stock market. You've seen the FTSE 100 rise by about 0.75%, some 55 points. But what's really interesting, among the big fallers are some of those banks that are very, very geared to the UK economy, the likes of Royal Bank of Scotland and Lloyds banking groups. Now, interest rate rises, all other things being equal, are pretty good for the banks because it widens the spread at which they charge borrowers and pay out to savers. So banks like to see interest rates rising, and the fact that you've seen Lloyds and RBS shares falling suggests that, again, the stock market is thinking, well, maybe this is a bit dovish after all. It doesn't necessarily appear to be implied in the fine detail.
Ian, thank you very much for that analysis. Of course, we'll speak to you throughout the course of the day on this subject.
Well, if you are just switching on, first time in 10 years, interest rates at the Bank of England have risen. They've risen by 0.25% to 0.5%. Let's go live to Westminster for some political reaction. The Liberal Democrat leader and former business secretary, Sir Vince Cable, is there. Sir Vince, a very good afternoon to you. Our business presenter, Ian King, there was making the point that there isn't much slack in the economy, according to Mark Carney. Unemployment's at a 42-year low. This interest rate rise is a reflection of if not a booming economy, then one that's not in terrible health.
Well, it's a very mixed story. I mean, the Bank of England has been terribly wrong before about slack in the economy. I think the governor thought that we'd reach full employment when it was around about 7%, and it's continued to fall. But of course, a lot of that employment is low productivity, it's low wage. I mean, although this interest rate increase is very tiny in itself, it is on top of other factors that have been squeezing household incomes. And the real significance, I think, as Ian King pointed out, is if this is a signal that interest rates are going to continue to rise as they have in the United States, and that we're moving away from the life support system of ultra-cheap money, this is really going to have a very serious effect on household incomes and on companies that are very highly borrowed, and that may account for the way that the markets are reacting.
Does there come a point where politicians, yourself included, need to coach the public on perhaps a different attitude towards borrowing in particular? If this is the beginning, as you say, looking to America, looking at what's happened there, if this is the beginning, I think Mark Carney talked about a very gradual rises in interest rates over the next 3 years. If this is the beginning of a change, ought there to be a message from politicians like you to borrowers?
Well, I think it's a very dangerous suggestion to suggest that politicians should coach the public in private finance. But, you make a serious point that, we are heading back to record levels of household debt. Some companies are very, very highly leveraged. and in a higher interest rate environment, they're going to suffer serious distress. I get a sense that that message is already beginning to be heard. There is some indication that consumer debt isn't rising so rapidly now. The governor has himself imposed measures. But I think the overall concern I have of speaking as a politician about what's happening this morning is reflected in the question that came from the floor a few minutes ago, which is what happens if the governor and his team have got this horribly wrong and they've made a mistake, because it may be that in a few weeks' time we have really bad news about the Brexit negotiations. They're going to have to reverse this, and there will be real egg on the face if that happens.
Interest rates have gone up for the first time in a decade. The Bank of England has increased the rate by 0.25% to 0.5% as it tries to control inflation. The bank's governor, Mark Carney, said households across the UK are generally well positioned to deal with the rate increase. The decision will mean higher monthly payments for millions with variable rate mortgages, but it's good news at last for savers. Here's our economics editor, Kamal Ahmed.
Dad, what's for dinner?
One small step upwards for interest rates, affecting millions of savers and millions of borrowers. It's more expensive if you have a mortgage, and for James Smith in South London, it is time to cut costs.
We've been very lucky without realising. I think it's going to start, it'll probably bite more from now on if we are going to start. If we can start, because for so long we've thought it's always going to be like this. And it's not, and you know, it's got to end sometime, but we never realised it was going to be this soon.
The governor of the Bank of England knew it was a delicate balancing act. The economy is still struggling, but he said rising prices had to be controlled.
So in many respects, today's decision is straightforward. With inflation high, slack disappearing, and the economy growing at rates above its speed limit, inflation is unlikely to return to the 2% target without some increase in interest rates. Of course, these aren't normal times. Brexit will redefine the UK's relationship with our largest trade and investment partner, and it will have consequences for the movement of goods, services, people and capital, as well as the real incomes of UK households.
This is certainly a historic moment for interest rates. And to realise why, it's worth remembering when incredibly low interest rates were not the norm. If we go back to 1992, when Britain was struggling with a currency crisis and Norman Lamont was Chancellor, interest rates hit 12%. In the era of cool Britannia, the economy righted itself and interest rates tumbled to 7%. But then the financial crisis hit. In a desperate attempt to keep global economies afloat, interest rates were slashed to 2%. So all of us could borrow cheaply and spend. But then, after the referendum, another cut to a record low of 0.25%. Today, the first rate rise for more than 10 years. How high could those interest rates now go? I asked the governor just that. Should we be ready for further rises?
The path would be very gradual relative to history and to a limited extent. And I can be a little more specific about that, which is the forecast we put out today. That requires about 2 more interest rate increases over the next 3 years.
Economists said it was clear why.
In the past, when you've had one rate hike, you usually have a series of them in quick succession. The world's not like that anymore. Growth is slower. Everyone's worried that if you hike rates now, the economy may soften too much. So I think they're going to wait. They may do one early next year, but that will depend on the economic data.
For millions of people, today is one they haven't experienced for 10 years, an interest rate rise. But with the key economic ingredient still being uncertainty, it is likely to be a long time before we see another one. Kamal Ahmed, BBC News.
So what exactly will the impact of today's rate rise be on savers and mortgage holders? And who will be most affected? Our personal finance correspondent Simon Gompertz has been finding out.
This street in Oldham, well, it's called The Rise. And that's a reminder to everyone living here of what we've all got to get used to, that the interest we pay and receive is on the rise. At the first house on the street, there's a welcome for higher rates from Sabina, a saver. So you're going to be looking forward to an increase?
I'm rubbing my hands together, definitely, yeah. Definitely. I'm hoping it'll go up a bit more as well to give us a bit more back.
Individual savings accounts, she has one of them, have £10,000 in them on average, earning typically just £30 a year of interest. That would go up to £55 if today's rate rise is passed on.
Been over 10 years, and it's about time that we just got a little bit more.
And now you're celebrating that the savings are going up?
Yeah, because I might only get, you know, like a couple of pounds, but I think this is the start of the rise.
Not everyone's affected by a rise in interest rates. 7 million people have got no savings at all, but 45 million have got savings and they'd hope for a benefit. There's another side to this, and that's the cost of mortgages. 15 million are renting, another 15 million own their homes outright, but 17 million people are paying into a mortgage, and nearly half of those are in imminent danger of an increase. And around this street, plenty will be feeling the effect.
We won't be spending as much on the going out and the just luxury items. We'll just be tightening the belt fully.
Ian, a builder, has run the numbers. He's paying £865 a month for his mortgage and expects a £50 increase, more than most will face.
£10, £12 a week, maybe £20 a week, who knows, which is not easy to find for anyone.
If interest rates did go up again, would that bring you to the brink?
Yes, it would, because wages, you can't just ask for a rise now where you would previously. Rises are hard to come by.
Every street has winners and losers, from the base rate going up to 0.5%. Add to that, and across the UK, the strains, as well as the gains, will multiply. Simon Gompertz, BBC News, Oldham.
Okay. This is good news, said the Governor of the Bank of England, about the decision to raise interest rates. Go for it, Matt.
Thank you so much, John. We'll carry it on. It is indeed good news. You're absolutely right. He said it was not such good news. You said it was good news. The Governor of the Bank of England said it was good news. Raising those rates, as we now know, from 0.25 to 0.5%, double, but still no more than a whisker. So what will that mean for the millions of us with mortgages and credit card debt? We'll have more from the Governor in a moment, but first, here's our business editor, Siobhan Kennedy.
For almost a decade, the sun has risen on rock-bottom interest rates, a bid to keep the economy moving. Today, the Bank of England ushered in a new era, the beginning of the end of cheap cash. There's no doubt this is a new dawn in recent British economic history. The Bank of England finally drawing a line under the years of easy money post the financial crisis. Interest rates are rising today for the first time in 10 years. Yet remarkably, the question still remains whether the British economy is robust enough to cope. Rates used to rise and fall with the economy, but in 2008 they were dramatically slashed during the financial crisis. They've stayed low ever since in a bid to boost the economy. But it's this line that the bank's most worried about. Inflation jumping to 3% since the Brexit vote, and it's that rise that's prompted it to act.
Our job effectively is to get inflation back to target in an 18 to 24-month horizon. That's the normal horizon. What we're doing is easing our foot off the accelerator. This is a modest adjustment in interest rates. It will have an impact on borrowers over time. It will have a more immediate positive impact on savers.
Janice Wadrup, a council worker in Birmingham, is in the middle of a 3-year pay freeze. She says today's rate hike will hurt, especially because she now relies on her credit cards and overdraft to get by each month.
But I find now that more and more I'm using them, you know, I've got my direct debits come out, but I'm using it more and more, you know, for food shopping, you know, getting my diesel, you know. I haven't had a holiday in over 12 months.
And the double whammy, she also has a tracker mortgage, so that will jump immediately.
I could lose my home. This is one I fear of many rate rises. It's just the start of pushing the button, to putting more people in poverty, you know, losing their homes.
But the Bank of England today said 60% of homeowners are now on fixed rate mortgages, so won't feel the rate impact immediately. It said the average mortgage holder owes £125,000, so would only see a £15 monthly increase. And while consumer debt is rising, it's doing so broadly in line with pay. But wages have stagnated, and while the bank is convinced they will pick up, others are less so.
Well, I think the big question really for the bank is what's going on with pay. We see pay growth being extremely tepid at the moment. The bank is going to have to think very carefully about any future rate rises and how that's going to affect the living standards of Britain's population.
Lord Miners was in government in 2008 when the financial crisis hit and rates were slashed. He believes the bank had to act.
We can't have monetary policy by fear. The Bank of England has to reconcile a number of competing objectives: inflation, economic health and growth, and the stability of the financial system. Keeping interest rates low has been responding to fear. What the bank has now done is nudge a little towards a programme of increasing interest rates, and it's done that because it said we can't continue to alone support economic activity.
Of course, the wild card in all this is the B word, Brexit. At the moment, the bank is basing its forecasts on the assumption that there'll be a smooth transition to a new trading relationship. Of course, there's absolutely no guarantee that that will happen. And if it doesn't, then the forecasts will need to change.
The MPC will, of course, react to developments to the extent they affect the outlook for inflation and activity. And in this regard, Brexit remains the biggest determinant of that outlook.
Mr. Carney says 2 further rate rises are penciled in for the next 3 years. But he also made clear that if Brexit throws us off course, the end of the decade of cheap money that began today could yet be reversed.
Siobhan Kennedy reporting. Well, now, earlier I asked Mark Carney whether, for the man and the woman in the street, this rate hike was good news or bad news.
This is good news. Look, what we're doing is we're easing a bit off the accelerator because we're in a position in the United Kingdom where more people are in work than ever before. Unemployment's at a 42-year low. We're in a position now where in order to make sure the economy grows at its speed limit or consistent with its speed limit, we need to just take a bit of that stimulus back. We're still going to be supporting the economy, supporting jobs and growth in the economy. Monetary policy is still quite stimulative. Secondly, we're in a position where this real income squeeze is starting to dissipate, starting to go away. And what we want to make sure is that once it goes away, it stays away. In other words, that the inflation part comes down, and by supporting the economy in a somewhat challenging period or uncertain period, that people can move forward.
But one charity estimates that there are some 8 million people who live on credit. They have to borrow for living expenses.
No, well,
I mean, for them, this, even 0.5% is going to make a big difference.
The British households have worked hard in the last decade. They've paid down a lot of debt. It's gone down by 20 percentage points relative to income. The other thing they have done is they have fixed the rates for a lot of their debt. So more people have fixed rate mortgages than ever before. And we fully recognize that people have burdens because of rents. We fully recognize that wage growth has been slower than it has been in the past. We recognize that people have other reasons why they're vulnerable, whether it has to do with health.
That full employment that you mentioned is often very bad employment.
Well, it's
0 hours contracts. It's, never really quite knowing.
And what we're starting to see, though, in the labor market is the quality of the employment is improving. We're starting to see people have much more confidence in terms of moving jobs because the job market is tightened significantly. And in this situation, what you don't want to do is leave it too long, so you slam on the brakes. What you want to do is just adjust a bit, still provide the support that the economy needs in these circumstances, and this is the policy. Monetary policy is the policy that's providing support.
Okay, but your prediction assumes a smooth adjustment to our new trading relationship, yes. Brexit. That's a massive assumption, given that we really seem to have made no progress at all, and a lot of people would describe it as well, verging on chaotic.
I think everyone knows that by the spring of 2019, Article 50 period runs out, and we will have some form or not of a transition arrangement with the European Union, and some form or not, or some indication or not of what the ultimate
very relaxed about some form or not.
Well, this is no. It's a question. These are negotiations, intense negotiations that are going on right now. What matters for the economy, how the economy is performing in the near term, is what do businesses, how are businesses and households reacting? They are not reacting as if chaos lies ahead. Now, John, important thing, between now and that March 2019 time, something's going to happen. We're going to get greater clarity about transition, about end state. At that point, expectations are going to change. They may become much more positive, they may become much more negative. We can react in that circumstance. The advantage of monetary policy, it is the most nimble macro instrument. We will react at that point, and it depends entirely on how events unfold.
So it doesn't keep you awake at night?
Well, what makes us work longer hours is background work to ensure as much as we can that Brexit is a success. So that means away from monetary policy, it means making sure that the core of this financial system is rock solid, that it's resilient to any possible outcome. And of course that means thinking about the worst possible outcomes so that people can rely on their banks, building societies, insurance companies, that they will be there when they need them, whatever happens, and we will deliver on that.
Governor, thank you for talking to us.
Thank you, John.
Back to the news of that interest rate rise. The Bank of England's move may be a sign of a more robust economy, but after a decade of no change, how will consumers respond to a hike in rates, however small? Our North of England correspondent Kieran Jenkins has been to Doncaster to find out.
£5. Can you find 5? Good girl.
Even a 3-year-old could tell you that you can't spend what you haven't got. The first rate rise in 10 years means for borrowers, keeping a lid on costs just got even tougher.
Look at that beautiful dress.
We're at St Aidan's Day Nursery in Doncaster, digesting the decision with 3 somewhat concerned parents. There's supermarket manager Jessica, dance school owner Lisa, and stay-at-home dad Lee. All of them are among the 1 in 3 households with a mortgage.
So this doesn't help you out?
No, not at all, no.
No, what's it going to mean?
Just really just an extra cost on my mortgage per month, so more outgoings.
Is that a cost that you can absorb?
Not comfortably, but we could do it as a family, yeah, I think so.
Can you afford to take on any more debt or to pay more for the debt that you've already got?
No. Not at all.
Food prices, of course, are up, inflation rising, and wages are not keeping pace.
When things arrive on the mat, be it the car insurance, the house insurance, I've never made a claim, but every year it is always more expensive.
With his wife at work, Lee does the weekly shop.
Everything just seems to have risen. I wasn't really informed of all the costs for food. My wife did a lot of supermarket shopping. She put the fuel in the car, for example. And I've come to realise that is a big rise since I was last out of work.
Is there more money coming in to make up for that?
No, I've not seen any sort of wage increases.
According to one analysis, the economy in South Yorkshire fell almost as sharply as crisis hit Greece in recent years. Higher costs will be felt keenly here, even for a family like Jessica's, where both parents work full-time.
About £100 a week is our limit, and that's got to include all the food shopping, any family days out, any like me using the car for work or him using the car for work. That £100's got to cover it all.
Lisa dare not increase prices at her fledgling dance school.
It's going to be a struggle for everybody, regardless of what they do for a living. I do try and help people, I give scholarships, I try and make a difference, but obviously I do need people to be able to pay for lessons too.
The economic picture has been rosier, and the parents here feel it and struggle to see beyond it.
Do you think that your daughter, who's only 3, do you think that she will be wealthier and more prosperous than you were?
No, because I think at the rate it's going now, with stuff getting more expensive, I don't see that changing. I think it'll just get worse. So when she's older, I don't think it'll be any better.
Are they ever going to be able to afford to buy a house, a home? Are they going to be able to move forward with their lives? Are they going to be stuck at home? Opportunity for work, what will they be able to do?
So where are we going with all this? If things are costing more and there's no more money coming in?
Do you know, I really couldn't tell you. We're not going to know better off after today's interest rise. And I really don't see where I'm going to find that extra money.
These are families who sense that the real pain may just be beginning. Kieran Jenkins, Channel 4 News, Doncaster.
I'm joined now by financial analyst Louise Cooper and also by Rupert Harrison, an economist at investment management firm BlackRock, who previously worked as Chief of Staff to George Osborne when he was Chancellor of the Exchequer. Welcome to you both. Well, you heard those voices there in Doncaster. I mean, people are very squeezed and stretched already. This rising in interest rates, I know it's only 0.25%, but it could make all the difference to some families, couldn't it, Rupert?
Yeah, it definitely makes a difference, and I know that people feel any move in interest rates. I think we have to remember the big picture is that interest rates are still very, very low. The Bank of England cut rates from what was already a very low 0.5% rate after the referendum. They were worried that there might be a bit of an emergency in the economy, so they cut rates to really emergency levels. I think whatever we can say about the economy now, it's clear there's no longer an emergency, so it probably makes sense to start to move them up very, very gradually.
And when we look back at the last 10 years, I mean, they have been so extraordinarily low, historically low. Did they do what it said on the tin? I mean, did they? I mean, they saved us from a worse recession, but did they reboot the economy in a way that it was supposed to happen?
Yes, clearly. However, there's downsides to that. And one of the downsides is there's a lot of debt.
That's right.
Because, of course, what happens with low interest rates is it encourages people. It encourages businesses, it encourages individuals, and it encourages governments to take a load of debt out because it's become a lot cheaper to do so. It sort of rips consumption from the future into now because you can do that via very, very cheap debt. So it's solved the depression of the crisis, but it's created another crisis in the potential crisis in that we're all massively indebted and addicted to low interest rates.
I mean, Mark Carney talked about this a few weeks ago. How serious is today's debt bubble, Rupert?
Well, I agree that interest rates were a very important part of recovering from the crisis, and they prevented what could have been a much, much worse outcome from the financial crisis. I have to say, I think that obviously there are individual families who have problems with debt, but as a whole, when you look at the economy, there's less debt than there was after the crisis. And I think that is because, banks have been what we call deleveraging. They've been reducing debt in the economy. More people are in work. Earnings have been going up, albeit very, very slowly. And I think that the level is still high, which is one of the reasons why we can see interest rates likely going up from here, but it will be very, very gradual. I think the Bank of England know that if they hike rates too sharply, then a lot of people will be in trouble.
I'm slightly confused about that because government indebtedness has gone from about 500 billion to 1.7 trillion. It's gone up over threefold, almost fourfold.
Household debt?
Household debt has never been so high because mortgage debt has never been so high because house prices are really, really expensive.
So household debt has come down since the crisis. So as a share of disposable income, it's been coming down. I think one of the things the bank are slightly worried about is that it's now showing signs of life.
As a share of disposable income, it's come down, but as an absolute figure, it's gone up.
But is this adjustment by 0.25% going to make a difference to that reality?
It's really no. And why people are getting worked up about it today is everyone thinks it's the beginning of rate increases.
Which it may not be.
I don't think that at all. This is a reversal of that emergency rate cut. If you look at what the market expects, the market's only saying 2 rate rises in the next 3 years, and we may not even get that.
All this depends on politics. It depends on Brexit negotiations. It depends on where we are with Europe in a year and a half from now, and we don't know that.
Well, we don't. And indeed, the Bank of England today were pretty pessimistic about the impact of Brexit on the economy. I think that if we take a step back, that's the real news today, is the Bank of England think the underlying growth rate of our economy is much slower than it was. So even with weak growth, they think that will cause inflation.
Are you saying that because your former boss predicted Armageddon when it comes to the economy, George Osborne?
Well, I'm a little less pessimistic. I mean, I still think Brexit is going to have a long-term detrimental impact on the economy. I have to say, I think the short-term gloom about the progress of the negotiations is a little overdone. And I think there probably is some upside surprise. And I think if that does happen, if we see, for example, a transition deal being agreed, then I think the Bank of England will start to raise interest rates because I think we will start to see wages starting to rise.
Yes, possibly. However, this economic cycle is already 5 years old. It
Yeah.
might not feel to many people because wages haven't gone up, but this is already a cycle that's long in the tooth. Predicting the economy to continue to grow for the next 3 years, history shows that economies don't grow forever. You have 5 years of upcycle, 18 months of down. We are due a recession. To forecast the next 3 years of growth.
Due a recession.
I'm not sure I agree with that.
Not straight away, but in the next 1, 2, 3 years.
Because of what? Because of Brexit?
But just because of the cycle.
I think because of the cycle?
I think it's a bit misleading that cycles don't die of old age. It's very important that we look back over long, long periods of time, centuries of data that we have. After a very, very deep financial crisis like we had, you can have very, very long recovery. So I don't think we should be alarmed about an imminent recession. I think if things go wrong, for example, in the Brexit negotiations, that's possible, but I think it's very unlikely.
But if we have another recession, rates will probably just go down again, won't they, to try and rebuild the economy?
But this is what I'm not saying a deep, dire recession.
There's not
I'm
a lot
saying
of room
slowdown.
there, is there? Yeah.
Well,
That's one of the big worries.
The fundamental problem is that rates have not been raised enough to cut them if the economy slows down. That is what actually should worry many people.
So we can't really use interest rates now the way that we used to use them because there's absolutely nowhere to go.
Well, I think we will
on the
see
downside.
further. I'm sure we will see further interest rate rises before we get into a situation where the Bank of England needs to start cutting again. And I think that that's probably in the back of their mind, is to have a bit of dry powder. But we will also see some of the extraordinary measures we saw in the crisis. Quantitative easing will be back in if we need it.
Rupert Harrison, Louise Cooper, thanks very much indeed.
Even though it had been heavily trailed and predicted, today's decision by the Bank of England to finally raise interest rates did feel like a watershed moment, not least because it's more than a decade, yes, it really is, since they last went up. The base rate was only increased by a modest 0.25% to the still equally modest 0.5%. But that means, of course, that the debts many of us have will cost more to service. And equally important, the Bank of England's governor clearly indicated further small rises are likely if inflation needs controlling. And that was really the heart of it. The bank has come under intense criticism from Brexiteers for its gloomy message on the economy. But it didn't pull its punches today. Britain was being held back as others moved ahead more quickly, it said, at least in part because of our decision to leave the European Union.
After years of sitting on its hands, the Bank of England has acted decisively, tonight moving to cool demand in an economy that isn't obviously overheating. Economic growth looks unheroic, but it's prices that are the problem. Inflation is high and rising.
With unemployment at a 42-year low, inflation running above target and growth just above its new lower speed limit, the time has come to ease our foot a little off the accelerator.
The last time the cost of borrowing went up was in July 2007, when bank rate reached 5.75%. A year later came the financial crisis. Interest rates tumbled to avoid economic catastrophe and flatlined for several years. Last August, they were cut again after the UK voted to leave the European Union. Today, that decision was reversed. Bank rate has reached 0.5%. The Bank of England says future rises will be gradual and limited. The market expects bank rate to reach 1% over the next 3 years, well below the pre-crisis peak. A few months ago, Mark Carney was arguing it was too soon to start raising interest rates. Now, he's changed his mind.
More people are in work than ever before. The economy is growing at a bit above its speed limit. That squeeze on real income that have affected your viewers is starting to dissipate.
Some people feel that this is premature, that you could wait a few months, things would be clearer. You're taking an unnecessary risk.
No, obviously we don't agree.
You said a squeeze on living standards is coming to an end. Another one's about to start, isn't it? Higher interest rates will take cash out of the pockets of borrowers.
Higher interest rates will do two things. One, they'll put cash into the pockets of savers. Yes, it will raise the cost of borrowing, but let's put that in perspective. British households have paid down debt over the course of the last, since the crisis. The number of borrowers who are in that vulnerable category, in other words, people who are paying 40% or more of their income on just paying off their debts, that is half the level it was before the crisis.
Mark Carney indicated this interest rate increase is not a one-off. More are likely to be necessary to bring inflation back to target. And yet the pound fell against the dollar and the euro today, suggesting investors see things differently.
Instead of signalling the start of a tightening cycle where the bank continues to raise rates, this does look like it's very much one and done, or it will wait and see before it thinks about hiking again.
Tonight, as commuters headed for home, the Bank of England set out on a journey of its own. The march back to more normal levels of interest rates will be slow. It may also be short-lived. Joel Hills, News at 10.
Well, within minutes of today's decision, banks and building societies fell into step and raised their rates. So the effects on people, borrowers and savers alike are already being felt. We went to one city, Swansea in South Wales, to take a cross-section of reactions to the Bank of England's move.
Everywhere there's a mix of savers and borrowers, and many cities are like Swansea with fragile economic growth. The question now is whether today's rate rise helps or hinders. The Gervaux-Ross family on a variable mortgage face extra payments of about £120 a year.
What kind of financial pressures do you think this rate rise will bring?
It's not the only thing that's going up in price. Everything else is going up in price, so it's just another thing added on that's going to cost us more money.
Around 3.7 million UK households are on variable rate mortgages. On average, they now face an extra £144 payment annually for every £100,000 borrowed. Savers currently get an average of just £3.90 for every £1,000 deposited. If today's rate rise is passed on, that would increase to £6.40. Rebecca Dick's saving for her first home, but earning as little as 0.5% on her ISA. With interest earnings pitiful, property continued to soar. Savers now want the rise passed on fast and in full.
Obviously, it has been a long time coming and it could have happened sooner, but any increase is going to help me at the moment as a saver. Not so much maybe once I bought my house, but as a saver it's going to help.
Morgan Marine manufactures industrial housing, employing 400.
Here we have our guys making the roof for a GRP building.
Here they fear a rate ripple effect. If people and companies are worried interest rises will continue, spending on all sorts of products could be hit.
In the short term, I think it will have a slowing down of the economy. It could affect us in our order book. Long term, it will strengthen the pound, which will benefit us as we import a lot of goods we buy a lot of goods from overseas.
In any community, some will have seen it all before, especially in the 80s, when rates hit 15%. For other borrowers, this will all be new. Now the cost of keeping a roof over their heads is about to rise for millions. Chris Choi, News at 10, Swansea.
And Joel is here now. Joel, various things in your report earlier, one and done, said one analyst. What do you think is the future for interest rates over the next year or so?
Well, I think the answer to that question lies, Tom, as Mark Carney was saying today, in the outcome of the negotiations that are currently going on with the European Union. We should know in the coming months more about what a transition period will look like after 2019 and also what our future trading relationship with the European Union will look like. And those things will influence very greatly in either a very positive way or potentially a very negative way what happens next in our economy. So, as Mark Carney was saying today, the next move may not be up. That's not an absolute given. But because of this uncertainty, it does rather beg the question, well, then why move now? The case for raising rates, many people think, isn't actually that compelling. Pay growth hasn't risen terribly fast. Economic growth is steady but extremely unspectacular. The bank is clear that interest rate rises are necessary to protect households and businesses from inflation, that households and businesses can endure higher interest rate rises. In fact, the bank calculates that a 0.25% increase in bank rate will leave the average household, Tom, £4 a month worse off. That's not financial hardship.
OK, but it painted a picture of a growing economy, but it also, as far as I could see, suggested other economies were doing much better and we were being held back. Give us not just Brexit.
Well, look, this
was part of it.
This is an interesting point because I think what was really striking today was that the factors behind the increase in interest rates wasn't that the economy has somehow taken great strides to robust health and shaken off the hangover from that terrible, terrible financial crisis. In fact, the bank seems to be of the view that actually the future potential growth of our economy, its ability to expand without creating inflation, has been permanently damaged by the financial crisis. Now, that's an issue to do with productivity that predates Brexit. This is, 10 years old, but it's an issue that Brexit, the Bank of England makes very clear, is likely to make worse.
OK, well, it didn't pull his punches, so let's see, Joel, for now. Thank you very much indeed.
It hasn't happened in more than a decade, but there are no fanfares, no fireworks. The Bank of England raised interest rates today, signalling a change in the economic weather. Is this a big moment or time for a bit of shoulder shrugging? Why has Monetary Committee done it? Is it because things are getting a little out of hand and we need to tighten up a bit? Well, consumers are showing a prodigious appetite for credit, creating a growing pile of personal debt. Money's been very cheap for a long time, but are they borrowing because they're trying to cope with the 3% inflation and near stagnant wages? If so, then they're going to get a shock, because mortgages and other repayments are going to rise and inflation is not expected to fall anytime soon. As for saving, it's unlikely that a 0.25% interest rate increase is going to turn us into a nation of savers, something that seems a part of a dim and distant past. Our business editor, Helen Thomas, has been trying to make sense of the Bank of England's move.
Economic predictions or your average weather forecast? It's hard to say which engenders less faith. And the first rise in interest rates in over 10 years, well, it hasn't done too much to clear things up.
Usually a rate rise would reflect strength, recovery, robust growth and confidence. This time, the economic weather feels a little different. So why has the bank acted now? The obvious answer is inflation. At 3%, it's well above the bank's 2% target. But most people agree that that's a temporary problem related to the fall in the pound. It should start to fix itself.
The Bank of England governor conceded the outlook is unusually uncertain, thanks in part to Brexit. Still, he said, it was time for a move.
In many respects, today's decision is straightforward. With inflation high, slack disappearing, and the economy growing at rates above its speed limit, inflation is unlikely to return to the 2% target without some increase in interest rates.
Once upon a time, the Bank of England's key interest rate moved up and down with the UK's economic fortunes. Higher interest rates turn the economic heat down, increasing the cost of borrowing and reducing spending. These are the last 4 periods the Bank of England was raising rates. Quarterly economic growth in the year before the first hike averaged 0.8%. Now, quarterly economic growth has recently been averaging about 0.4%. Even more unusual, this rate hike comes as real wages have been falling. That is, wage growth adjusted for inflation.
I think they made a mistake. I think, at best, their decision to raise rates today was premature, and at worst it could be pretty reckless. The risk is if you raise rates against a backdrop of economic weakness, it tends to frighten the horses a little, and what you may see is that consumers who are already running with very high levels of debt against a backdrop of pretty tough financial conditions choose to build their savings up a little bit more than the Bank of England would like and actually precipitate something of a steeper slowdown than we're already seeing.
So this wasn't a normal rate hike, but as Mark Carney said, we don't live in normal times. A decade of interest rates at virtually zero is certainly extraordinary, and for some, the central bank had to at least start the journey back to more conventional levels.
Ultra-low interest rates have their costs as well as their benefits, and if you're in a position where interest rates are expected to remain near zero for the foreseeable future, that creates all sorts of distortions in the economy, misallocation of resources and so on. If you can get interest rates back towards more normal levels over the next few years, then also you've got a bit of margin to cut again if you need to. So for example, if the Brexit negotiations do go badly, then the Bank of England will have more scope to cut rates in future than it would have done if it hadn't raised rates today at all.
This was a small move from a very low level. And of course, it only takes rates back to where they were in the summer of 2016, before the post-referendum cut. Still, it all came with a gloomy outlook. In the bank's view, the economy has hit its limit. The economic climate now is about as good as it's going to get. That's in part because productivity, a big determinant of economic potential, has flatlined since the financial crisis.
The Bank of England are taking a pretty conservative view about the UK's potential supply growth. They're seeing growth around 1.5% as being our sort of long-term position. I think what's really important, what businesses want to see, is that we have the right environment to invest, and that we're investing in our skills, in our education and our infrastructure. And I think that's why actually what the business community wants to see is more action by Philip Hammond than Mark Carney, and I think that's why all eyes will be on the budget later this month.
It's official. Interest rates are rising again, but so is the pressure.
And Thomas, well, what should we make of today's move, and is there anything in the American experience we should learn from, where rates have already been rising for a while? I'm joined from New York by Gillian Tett of the Financial Times. Good evening, Gillian. Thank you very much for joining us. You know, so here, looking at this side of the pond, with inflation on the rise, unemployment low, was this the right time to move? Are we heading for more normal times, do you think?
Well, I'm in the camp of people who think that it was the right time to move, and we have had extraordinarily abnormal times now for the best part of the last decade. And the ultra-low interest rates were introduced initially as an emergency response after the financial crisis, but that was a long time ago. So I personally think that getting back to a more normal world is healthy, and it's something that America's been doing now for 18 months, over 18 months now, and so far the markets have absorbed it fairly calmly.
But if you look, are we now just going to have to accept, in this country at least, that growth is sluggish? I mean, growth is reasonably sluggish, but in the States there's an acceptance that that indeed is the norm, and that actually even in that position you will raise interest rates, and it looks like the Americans will raise interest rates next month, even though growth is not that strong.
Well, essentially what the central bank in America is trying to do, and in many ways it's exactly what Mark Carney is trying to do in the UK, is a bit like the pilot of a plane that's trying to lose altitude very slowly and very gently over a long period of time. They're trying to, if you like, return slowly to a more normal world without anyone noticing. I mean, and let's keep this in perspective. 25 basis point rise is not exactly dramatic. The type of rate rises we've seen in the US haven't been dramatic. But it is a sign that the central bank is moving into a slightly more normal world, and as Helen says, they're creating a bit of reserve firepower for themselves to use if there is another crisis.
Well, let's talk about that reserve firepower, because we're joined now from Florida by Professor David Blanchflower, former member of the Bank of England's Monetary Policy Committee. David Blanchflower, good evening. Do you think it was necessary to create some firepower, or indeed will it create firepower?
No. I don't normally disagree with my friend Gillian. I'm afraid this looks to be a big mistake to me. The way you create firepower is not to create a recession yourself. I mean, people want to raise rates, so when a recession comes, you can cut rates. This looks like an enormous mistake. There's nothing in the data whatsoever to actually sustain it. It looks to me very much like the rate rise that was done in July 2007, that I actually voted against. It was returned a few months later, and then we went into recession. I think this is a huge mistake. The reality is that there is absolutely no data that says you should do it now. And with the uncertainty over Brexit, with the uncertainty over the fiscal position of the government, this looks like a big mistake.
So you've got, not only you've got, sterling on the floor, as you say, you've got the uncertainty of Brexit.
Right.
In the States, you've got
Right.
a president who says he's going to cut taxes and simplify taxes. That perhaps leads to more optimism, but you don't have that necessarily coming out of Phil Hammond's briefcase.
Well, right. Well, what you have in the US is talk about a huge fiscal cut, huge stimulus going into the US economy, which is pushing up. I mean, growth is double what it is in the UK. Real wages have risen in the US over the last 4 or 5 years. Real wages are down in the US. Be aware, the US is the slowest growing economy in Europe. Growth is going to slow. On any measure, this looks disastrous. Real wages are down. And now what you're going to do is you're going to raise the cost of borrowing to people, not only to homeowners, but also to firms who are going to cut their dividends. So this looks like a huge mistake.
So if, Gillian Tett, on the basis of a 0.25% increase, you're not going to have consumers jumping up and down and saying, well, we're going to save now, we're going to save, because the debt mountain is growing so much. We're going to have an increase tomorrow in mortgage rates, and the APRs on the credit cards are going to go sky high.
Well, not exactly sky high. I mean, I said let's keep this in perspective. I mean, the question that I would throw back at Danny Blanchflower is, what do you make of the fact that consumer credit in the UK has been growing really quite sharply? Does that not concern you at all?
Well, how do you make sure the consumers don't take out those huge amounts of credit then, David Blanchflower? You've got
well,
wages
you can
stagnant.
deal with that. The FPC can deal with. So you've got the likelihood is that retail sales are falling. They're about to plummet as people realise they shouldn't have been saving. So that will fix it. You've already seen that, and this will make it much worse. It's going to lower output. So that seems like a really crazy way. You're going to force yourself into a recession. Yes, it's a small mistake, but it's better than making a big mistake. But I would rather not make a mistake at all. So yeah, credit is rising. It's been a surprise to the central bank, but pretty darn soon that's going to stop because people's real wages are falling.
Is it possible?
So essentially what you're arguing is that you'd like to create more of a consumer credit bubble, even as the underlying fundamentals in the UK are not so healthy. That's simply, eating your jam today and creating more problems in the future.
David Blanchflower.
The economy is being held together by the stimulus from the central bank. If you want to deal with the credit problems, deal with that through credit restrictions or whatever. But think about the streets of Hartlepool, Blackpool, Wakefield. You really think that there's a credit boom going on there? I think not. People are struggling. Why do you think in those places people voted for Brexit? They didn't vote for Brexit because there was a boom going on and they were doing absolutely great. That's absolutely not true. So the economy is basically flat. Yes, there's some credit going on. People have been spending more than they should have, but the economy's hurting.
Thank you both very much indeed.